In 1637, a single tulip bulb sold for the price of an Amsterdam mansion, and nobody involved had ever seen the bulb. Here's where the money actually went. The Dutch Golden Age was printing wealth faster than anywhere else in Europe. Amsterdam was the financial hub, spice trade, shipping routes, colonial ventures, all funneling cash into merchant pockets. By the 1630s, the middle class had money to spend on things beyond survival, and that's when tulips showed up. Tulips weren't native to the Netherlands, they came from Turkey through diplomatic channels. But here's the trick, some bulbs produced flowers with flame-like striped patterns, red streaks on white petals, yellow breaks through purple. These weren't planned, a virus caused it, but nobody knew that yet. They looked like magic. So why did the price spiral into insanity? Scarcity, a virus-infected bulb couldn't be reliably reproduced. Plant one and you might get the striped flower, or you might get solid color. The odds were random. That unpredictability made rare varieties genuinely rare, and rare meant expensive. Wealthy collectors started bidding, prices climbed, then something shifted the entire market structure. The Dutch created a futures market for bulbs. Growers would sell bulbs that hadn't bloomed yet, sometimes wouldn't bloom for months. Buyers paid in advance based on reputation and past performance. Sounds reasonable, except traders started flipping these contracts. Person A buys a future. Before the bulb arrives, person B buys that same future from person at a markup. Person C buys from person B. The actual bulb never changes hands, but the price keeps doubling. And here's the trick, these trades happen in taverns, not formal exchanges. No central registry, no legal framework. Contracts were handshake deals written on napkins. A weaver could buy a futures contract for a rare viceroy bulb. He'd never grown anything, he'd never seen the bulb. He just knew the guy next to him paid triple what the last guy paid, so he bid higher. By 1636, the market was detached from reality. A single Semper Augustus bulb, one of the rarest, reportedly sold for 6,000 guilders. That's equivalent to a grand Amsterdam townhouse with land. Traders were betting fortunes on flowers they couldn't even see. The contracts were binding, but enforcement was murky. When did you have to pay? When the bulb bloomed? When you signed? Nobody wrote that down. The bubble inflated because the cash flow worked. Early buyers made money, they sold at profit. New money came in, prices rose, more profit. The system fed itself, but it only worked if someone was always willing to pay more, and that's fragile. One crack and the entire structure collapses. Spring 1637. The tulip season arrived. Growers delivered bulbs. Traders who'd signed contracts suddenly faced payment deadlines. And here's what happened, buyers started refusing to complete transactions. The prices had climbed so high that the actual flower wasn't worth what the contract promised, so they walked away. Without buyers, prices collapsed overnight. Contracts that represented fortunes became worthless paper. Traders couldn't sell because there was no one buying. The tavern deals that seemed so profitable turned into debts. Some historians debate how many people actually lost everything. The records are messy and incomplete, but the panic was real. The legal aftermath was chaos. Buyers claimed the contracts weren't binding because they were tavern conversations, not formal transactions. Sellers demanded payment. Courts eventually ruled that the deals were unenforceable. Essentially, the buyer could walk away. It was the first recorded financial bubble where the legal system refused to force settlement. But follow the actual money. Most traders who entered the market early, the original collectors, made real profits before the crash. The losses fell on late arrivals. Weavers, tailors, chimney sweeps who'd been convinced by tavern talk that tulips were a path to wealth. They bought at the peak. They couldn't sell. They lost what they'd saved. The Dutch economy didn't collapse. Amsterdam didn't burn down. Most historians now agree the hysteria around Tulip Mania was exaggerated by later writers. But that doesn't mean nothing happened. Real people made and lost real money. The structure of the bubble, futures trading, leverage, herd psychology, lack of regulation, that structure remained. It would repeat. Which brings us back to the original question, how did a flower bulb crash a nation? It didn't, not really. But a futures market without regulation, a middle class with surplus capital, psychological pressure to keep up with your neighbors, and a product nobody could actually evaluate, that combination did. The tulip was just the vehicle. What made Tulip Mania possible was the same thing that makes any bubble possible. A gap between what people think something is worth and what it actually is. The flower still had value, but the contract price had divorced from reality. And when reality arrived in spring 1637, the math didn't work anymore. The forensic detail worth noting, the crash happened because the legal system refused to enforce contracts that both parties had signed. Courts said essentially these are unenforceable tavern deals. That decision protected later buyers but devastated sellers and early speculators. It was a reset button, but resets only work if everyone accepts the loss. Though what actually happened to the tulip market after 1637? It stabilized. Prices returned to more reasonable levels. Collectors still bought rare bulbs, but at prices that reflected actual scarcity, not speculative fever. The virus-striped flowers remained beautiful. They just stopped being treated as financial instruments. The flower survived. The bubble didn't. Tulip Mania wasn't a crash because someone was greedy or stupid. It was a crash because the infrastructure, futures markets, informal contracts, no regulation created conditions where prices could detach from value. The Dutch had built something new, a financial system. And like all new systems, it had vulnerabilities nobody saw until they broke. The real lesson isn't that tulips were overvalued. It's that any asset, stocks, real estate, cryptocurrency, meme coins, baseball cards, can become a bubble when three conditions align: scarcity, leverage, and uncertainty about actual value. Change the asset, keep those conditions, and you get the same crash, different flower. That pattern has repeated for 400 years, and it will again. This video is for educational and informational purposes only and is not financial advice. Always do your own research. If you want to understand how financial systems fail before they fail, subscribe. There's a new forensic breakdown every week. This video is for educational and informational purposes only and is not financial advice. Always do your own research.